It happened at exactly 10:14 a.m. I was watching the XAU/USD chart. Gold was sitting pretty at an all-time high of $5,608 per ounce. The narrative was perfect. Inflation was roaring, and the world was scared. Then, without a single headline crossing the wire, the floor gave way. It wasn't a slide. It was an execution. In 45 minutes, $700 of value evaporated. A vertical red line that defied every law of supply and demand. The financial media called it profit-taking. They said the market was overheated. Bullshit. Retail investors don't coordinate a mass sell-off of that magnitude in under an hour. This was institutional liquidation, a planned demolition. 2 hours later, the news broke. Donald Trump nominated Kevin Warsh as the next Fed chair, the architect of the strong dollar, the enemy of gold. Suddenly, the red candle made sense. Someone knew Warsh was the pick before the ink was dry on the press release. They shorted the top, took your liquidity, and left millions of retail accounts holding a bag that is now 15% lighter. You think this is just market volatility? No. You just witnessed the greatest wealth transfer of 2026, and I have the flight logs to prove who was in the cockpit. Let's pull up the 5-minute candle chart for XAUUSD and look at the body on the floor. I want you to focus on the time stamp. 10:14 in the morning, Eastern Standard Time, on January 30th. Up until that exact second, gold was trading comfortably above $5,600 an ounce. The trend lines were bullish. The momentum indicators were flashing buy signals. Then, in a single 5-minute window, a massive sell order hit the COMEX futures market. This wasn't a slide. It was a cliff. What makes this forensic analysis interesting is not the drop itself, but what happened right next door. Look at the silver chart for the same time frame. Usually silver is gold's more volatile little brother. If gold sneezes, silver catches a cold. If gold drops 1%, silver usually drops too. But at 10:14 a.m., when gold began its death, spiral silver actually held its ground for another full 15 minutes. It traded sideways. This is a massive anomaly. It tells us that this was not a broad market panic. It wasn't a sudden rush to cash. It was a surgical strike specifically targeting the gold order book. The algorithms that run the modern financial world usually dump everything at once during a panic, but they didn't do that here. They waited. This hesitation in the silver market is the fingerprint of a human decision, not a machine error. Someone was unloading a specific asset class with extreme prejudice. Now let's talk about the weapon used in this assault. His name is Kevin Warsh. To the average person walking down the street, that name means nothing. But to the high-frequency trading desks on Wall Street, Kevin Warsh is the financial equivalent of a nuclear winter. Jerome Powell has spent the last few years printing money to keep the system liquid, which drives gold up. Warsh is the anti-Powell. He is the youngest governor in Fed history and a staunch advocate for sound money. He believes in positive real interest rates. He believes the dollar should be a fortress, not a confetti cannon. When you nominate a man like Warsh, you are effectively declaring war on inflation hedges. You are telling the market that the era of easy money is over. If Powell is the bartender keeping the drinks flowing, Warsh is the cop turning on the lights and arresting everyone. The market knows this. The algorithms are programmed to react to his name. The moment the newswire flashed his nomination at noon, gold was mathematically destined to crash. The logic holds up, but there is a problem with the timeline, a big problem. This is where the official narrative falls apart, and where you need to pay very close attention, because the devil is in the timestamps. The White House did not release the official statement regarding Kevin Warsh until well after the lunch hour. The Bloomberg terminals didn't flash the red headline until the afternoon session was underway. Yet the execution of gold began at 10:14 in the morning. That is nearly 2 hours before the public knew a thing. If you are trying to connect these invisible dots between political maneuvering and market manipulation, you are in the right place. So make sure you are following along, because the mainstream news will never show you this level of granularity. We are looking at a gap of 120 minutes. In the world of high-frequency trading, where nanoseconds cost millions, 120 minutes is an eternity. It is enough time to move billions of dollars without slipping the price too much if you are careful. But they weren't careful. They were desperate. The volume data from the COMEX confirms that the selling pressure at 10:14 was 300% higher than the 30-day average. That is not retail investors taking profit. That is not your uncle selling his gold coins because he thinks the price is high. That is institutional liquidation. That is a whale exiting the building before the fire alarm rings. They knew. There is no other mathematical explanation. A select group of insiders knew that Warsh was the pick. They knew that once his name hit the wire, the algorithm would tank the price of gold. So they front-ran the news. They sold the top at $5,600, using the liquidity provided by retail investors who were still buying the breakout. They handed their heavy bags to you, and then they stepped back and watched the news destroy your position. This is what creates the smoke. The media is calling it profit-taking. They are calling it a technical correction. They are lying to your face. You do not get a $700 drop in 24 hours from profit-taking. You get it from inside information. If you are looking for someone to tell you that it is going to be okay and that the price will bounce back tomorrow morning so you can sleep better tonight, then you should turn this off right now. This is not that kind of investigation. I am not here to give you financial advice or comfort. But if you want to know exactly who was on the other side of that trade, and who sold you that gold at the absolute peak while holding a glass of champagne, then pour yourself another cup of coffee, because we are just getting started. We have established the crime scene, and we have identified the weapon, but we still need to find the body. To move that much gold without breaking the exchange entirely, they needed a mechanism, a structural flaw in the way the market handles volume that almost nobody talks about. To understand the violence of what happened at 10:14 a.m., you first have to understand the physics of a whale dump. You cannot move a mountain with a spoon, and you cannot crash the gold market with a retail trading account. When a retail investor sells gold, they are usually liquidating a few ounces, or maybe closing a single futures contract. It is a drop of water in the ocean. It creates no ripples, but what we witnessed on January 30th was not a collection of individuals deciding to sell at the same time. It was a structural detonation. We need to look at the order book density to see the fingerprint of the killer. In a normal market, you have a healthy balance of limit buy orders sitting below the price and limit sell orders sitting above it. This provides a cushion. When a whale wants to exit a position gracefully, they use what we call iceberg orders. They break their massive block of sell orders into tiny, invisible chunks and feed them into the market slowly over days or weeks, so they do not disturb the price. They hide their movements because they want the best possible price. But the entity that sold yesterday did not care about getting the best price. They cared about speed. They utilized aggressive high-frequency trading algorithms that slammed market sell orders into the bid stack relentlessly. They chewed through every buy order from 5,600 down to 5,200 in a matter of seconds. This is what we call sweeping the book. It is an act of financial aggression. It is the equivalent of burning down a warehouse to claim the insurance money. Why would a rational actor destroy the value of their own assets so quickly? The answer is simple and chilling. They were not selling to take profit. They were selling to trigger a cascade. They were hunting for stop losses. This brings us to the suspect list. In the world of precious metals, We divide the players into two camps: the speculators and the commercials. The speculators are the hedge funds and the retail traders who bet on the price going up. The commercials are the bullion banks, the massive institutions like J.P. Morgan and HSBC, who facilitate the trade and often take the other side of the wager. Historically, the commercials hold massive net short positions. This means they make money when gold goes down, and they bleed money when gold goes up. With gold hitting all-time highs near $5,600, these banks were sitting on billions of dollars in unrealized losses. They were in the danger zone. If the price kept rising, they would face a margin call that could bankrupt a small nation. They needed a miracle, or they needed a weapon. Kevin Warsh was that weapon. The timing of the dump suggests that the commercials received early intelligence regarding the nomination. Knowing that Warsh is an advocate for a strong dollar and positive real interest rates, they knew his appointment would be the fundamental catalyst to crush the gold rally. But they couldn't wait for the news to break. If they waited until the announcement, everyone would sell at once, and the liquidity would dry up. They needed to exit their short positions and flip the market before the crowd reacted. So they executed a liquidity grab. This is the cruelest part of the game. To sell billions of dollars worth of gold, you need someone to buy it. You need a counterparty, and that counterparty was you. Look at the chart in the 24 hours leading up to the crash. Gold was grinding higher in a parabolic arc. The relative strength index was pinned above 80, which is extreme overbought territory. The sentiment indicators were flashing extreme greed. Retail traders were piling in, leveraging their houses, maxing out their credit cards, convinced that gold was going to $6,000 by Friday. The insiders let the price run up to $5,600 specifically to draw in this retail liquidity. They needed you to be greedy. They needed you to place your buy orders at the top so they had someone to sell to. It was a transfer of wealth disguised as a bull market. The moment the retail volume hit its peak, the trap was sprung. The insiders dumped their holdings into the buying frenzy, effectively handing the bag to the public just moments before pulling the rug out. This is why the Warsh nomination is not just a news headline, it is a regime change. For the last few years, the market has been betting on the debasement of the dollar. We bought gold because we believed the Federal Reserve had lost control and would print money to infinity. Jerome Powell was viewed as weak, but Kevin Warsh is a different animal. He is a disciple of the Volcker era. He believes that pain is necessary to cure the economy. His nomination signals that the United States is willing to risk a recession and a stock market crash to save the currency. For gold, which acts as a hedge against currency debasement, this is the worst possible scenario. The insiders understood this implication immediately. They didn't just sell gold because they liked the dollar. They sold gold because the entire investment thesis for the last 5 years was deleted in a single afternoon. The devastation we are seeing now is the result of leverage unwinding. When the price smashed through $4,900, it triggered a chain reaction of forced liquidations. Retail traders who bought at the top on margin were wiped out instantly. Their brokers automatically sold their positions to cover the losses, which drove the price down even further, creating a feedback loop of destruction. This is exactly what the whales wanted. They cleared the board. Now they are sitting on cash while the retail public is paralyzed by losses. We are witnessing a classic case of information asymmetry, where the speed of light is too slow for the common man. The institutions have fiber optic cables connected directly to the exchange matching engines. They have algorithms that parse news headlines in microseconds. And most importantly, they have the network to know who the president is going to nominate before he even walks up to the podium. While you were refreshing your browser, waiting for the news, they had already positioned themselves for the aftermath. The giant banks and shadow institutions have already quietly arranged their pieces on the board, while the crowd is still staring, mesmerized, at the flashing red numbers on their screens, oblivious to the fact that the game was decided before the opening bell even rang. But to prove this beyond a shadow of a doubt, we cannot just rely on theory. We need to open the hood and look at the engine of the market itself, because there is a specific technical report that comes out of the COMEX that they usually try to bury. And what it shows for this week is absolutely terrifying. If you want to track a predator in the deep ocean, you do not look at the surface waves. The surface is where the noise happens. It is where the media screams about panic selling and profit-taking. To find the whale, you have to look at the water displacement deep below the hull. In the financial markets, the displacement is recorded in a document that the bullion banks pray you never learn to read properly. It is called the Commitment of Traders Report, or the COT. This is our sonar, and when we ping the depths of the COMEX market for the week leading up to the crash, the return signal is absolutely massive. On a standard chart, you see the price of gold going up. You see green candles. You feel good. But inside the COT report, there is a column for the commercials. These are the swap dealers and the bullion banks, the entities that actually run the casino. While the price was climbing to that historic $5,600 mark, the commercials were not buying. They were doing the exact opposite. They were building the largest net short position we have seen in over a decade. Every time you bought a contract thinking the price was going to the moon, they were the ones selling it to you. They were feeding the frenzy. They were filling their warehouse with short contracts, essentially betting billions that the price would collapse. Think about the logic of a predator here. If they truly believed gold was going to $10,000 because of inflation, why were they betting the house against it? Because they knew something you didn't. They knew the Warsh announcement was coming. They positioned themselves perfectly to profit from a crash that hadn't happened yet. The data shows that the spread between the commercials and the speculators reached a historic extreme exactly 48 hours before the drop. The speculators, which includes the hedge funds and the retail crowd, were all in on the long side. The commercials were all in on the short side. When you see a divergence that wide, it is not a market disagreement. It is a slaughter in the making. The commercials do not lose money. If they are short, they will find a way to make the price go down. And Kevin Warsh was the button they pressed to make it happen. Now we need to look at the blood in the water. We do this by analyzing open interest, or OI. Open interest represents the total number of active contracts open in the market. It is the fuel in the engine. In a healthy organic sell-off, you usually see open interest rise because new bears are entering the market to short the price down. But look at what happened on January 30th. As the price plummeted $700, the open interest didn't rise. It collapsed. It fell off a cliff. This is the smoking gun of a whale exit. It means that the selling wasn't driven by new people betting on a downtrend. It was driven by the commercials buying back the short positions they opened at the top. They shorted at $5,600. And as the price crashed, they bought those contracts back at $4,900, closing out their position and pocketing the difference. This is what we call a short covering raid. They smashed the price down specifically to cash out their winning tickets. They didn't sell because they hate gold. They sold because they love money, and they just took yours. Stop for a second and look at this pattern with me, because it is crucial that we are on the same page before we go deeper. I am looking at a chart that looks less like a trading diagram and more like a crime scene photo. You have the motive, which is the Warsh nomination, and you have the weapon, which is the massive short leverage. But I need to know if you are seeing this the same way I am, or if I am just staring at static. Do you believe what the news is telling you, that this was just natural market volatility and profit-taking? Or do you see the deliberate footprints of institutional manipulation that I am pointing out? If you think this was a rigged game from the start, and you can see the whale's teeth marks on the chart. I want you to go down to the comments right now and simply type the word whale. Just that one word. It tells me that you are awake and that you are watching the same data I am. The manipulation becomes even more obvious when we step away from the glowing screens and walk into the real world. This is where the paper market disconnects from reality. The price of gold on the screen is what we call the spot price. It is the price of a paper promise. But try to take that paper money and go buy a physical gold eagle or a buffalo coin right now. If gold really crashed 8%, the price of the physical coin should be 8% cheaper, right? Wrong. I called 3 major bullion dealers this morning while the screen price was flashing red. I asked for a quote on a 1-ounce coin. The premium has exploded. The spread between the spot price and the physical price has blown out to levels we haven't seen since the liquidity crisis of 2008. The dealers are not selling at the screen price. They know the paper price is fake. They know that the physical metal is scarce. So while the algorithms are dumping paper contracts to scare you out of your position, the smart money is actually using this dip to accumulate physical metal. This is the ultimate misdirection. The whales crash the paper price to create panic. You get scared and you sell your physical gold or your ETF shares. Who do you think is buying them? The same people who crashed the market. They are using the paper market to suppress the price so they can buy the real asset at a discount. It is a classic bait and switch. They sell you a paper promise at the top, and then they steal your real gold at the bottom. If you look at the Shanghai Gold Exchange, which is a physical delivery market, the price did not crash anywhere near as hard as it did in New York. The spread between Shanghai and New York is now over $100 an ounce. This means that gold is flowing from west to east. The Western banks are suppressing the price, and the Eastern central banks are backing up the truck to buy it all. We are watching a physical drain of the COMEX vaults disguised as a price crash. This technical divergence suggests that the commercials are not done yet. They have cleared out the leverage and they have reset the board. But the fact that they are willing to blow out the spread between paper and physical tells me that this isn't just about profit anymore. This is about control. They are preparing for something that requires physical possession of the asset, not just a paper claim on it. And to understand why they are suddenly so desperate to hold the real metal in their vaults, we have to look away from the charts and look at the map of the world, because there is a geopolitical storm forming that makes this financial crash look like a light drizzle. We have tracked the sharks swimming in the New York harbor, but if you really want to understand why they attacked yesterday, you have to lift your head up and look at the ocean itself. The manipulation we witnessed on the COMEX is not just about quarterly bonuses for a few traders at JP Morgan. Those banks are just the foot soldiers. The orders are coming from much higher up. What happened to gold is not a market correction. It is an act of geopolitical warfare. To understand this, you have to realize that Kevin Warsh is not just a central banker. He is a weapon. The Trump administration knows that the greatest threat to American hegemony is not a missile from North Korea, but the slow erosion of the US dollar's status as the world reserve currency. The BRICS nations led by China and Russia have been openly stockpiling gold for 5 years. They are building an alternative financial system backed by hard assets to bypass the dollar. Every time the price of gold hits a new all-time high, it is a direct vote of no confidence in the American empire. It screams to the world that the dollar is weak and that the debt is unsustainable. So when they nominate Kevin Warsh, they are effectively deploying a financial nuclear deterrent. Warsh is the architect of the strong dollar policy. His ideology is simple: crush inflation, raise real rates, make the dollar the king of the hill again. By appointing him, they are sending a signal to Beijing and Moscow. They are saying we will crash the global economy if we have to, but we will not let the dollar die. The $700 drop in gold was a calculated strike against the balance sheets of America's rivals. Think about it. The People's Bank of China holds over 2,000 tons of gold. By crashing the price by 15% in 24 hours, the U.S. effectively wiped billions of dollars of value off China's war chest. It was a margin call on the enemies of the West. But here is where the whale hunt gets truly interesting. If this was a successful attack, why isn't China panicking? I have been monitoring the flow of physical metal into the Shanghai Gold Exchange, and the numbers tell a completely different story. While the Western paper whales were dumping futures contracts in New York, the Eastern sovereign whales were standing there with their mouths open, swallowing every single ounce of physical metal that hit the floor. The import data shows a surge in gold moving from Swiss refineries to Hong Kong vaults. This is the great irony of the Warsh trade. The West is smashing the price to make the dollar look strong, but in doing so, they are allowing the East to exchange their paper dollars for real gold at a massive discount. We are selling the family silver to pay the credit card bill, and our rivals are the ones buying it at a yard sale price. This brings us to the domestic nightmare, the paradox that Warsh and his supporters are trying to hide from you. They want you to believe that a strong dollar is good for you. They want you to think that crashing gold means inflation is over, and that your grocery bill is going to go down. This is a lie. A strong dollar destroys American manufacturing because it makes our exports too expensive. It kills the earnings of the companies in your 401k because they sell their products overseas. But the most terrifying variable is the debt. The United States government is $36 trillion in debt. To pay the interest on that debt, they need low interest rates and a weaker dollar. If Warsh actually does what he says he is going to do, if he keeps rates high to defend the dollar, the interest payments on the national debt will explode. It will consume the entire federal budget. We are looking at a mathematical impossibility. They cannot have a strong dollar and a solvent government at the same time. So what we saw yesterday was a bluff. It was a piece of theater designed to scare the speculators and shake out the weak hands. They crashed gold to paint a picture of stability, but underneath the surface, the foundation is rotting. You might feel good today because the gas price ticked down a few cents, but ask yourself what happens to your pension fund when the bond market realizes that the U.S. government can't afford to pay its bills. The insiders know this. That is why they are playing this game of musical chairs. They are using the volatility to transfer wealth from the public to the private sector before the music stops for good. The tragic part is that the average American is cheering for this. They see gold crashing, and they think it means the economy is healing. They don't realize that gold is the canary in the coal mine. When you kill the canary, the air doesn't get cleaner. You just stop getting the warning signal. We are now flying blind into a storm that has been building for decades. The banks have hedged their bets. The Chinese have filled their vaults. The politicians have their talking points. But you and I are left holding a currency that is being artificially propped up by a man who is willing to burn the village to save the reputation of the bank. The trap has been set, and the door has been locked. But there is one final piece of evidence that reveals exactly how this game ends, and it requires us to stop looking at the money entirely and start looking at the psychology of the people running the simulation. 2,000 years ago, the philosopher Plato described a cave where prisoners were chained, facing a blank wall. Behind them was a fire, and between the fire and the prisoners, puppeteers held up objects that cast shadows on the wall. The prisoners, having never seen the outside world, believed that these flickering shadows were reality. They gave them names. They feared them. They worshipped them. Today, your computer screen is the wall of that cave. The glowing green and red numbers you stare at all day. The ticker symbol that says 5,600 or 4,900. These are not reality. They are shadows. They are optical illusions cast by a fire that is controlled by the Federal Reserve. When Jerome Powell held the torch, the shadows looked tall, and you felt rich. Now Kevin Warsh has taken the torch, and he has moved the light. The shadows have shrunk. The prisoners are screaming in terror because they think their wealth has vanished. But turn your head. Look away from the wall. Look at the object itself. The gold bar in your safe has not changed. It weighs exactly the same as it did yesterday. It has the same atomic structure. It occupies the same amount of space in the physical universe. The only thing that has changed is the length of the shadow cast by the dollar. This entire crash, this panic, this volatility is a psychological operation designed to keep you focused on the shadow so you never look at the man holding the torch. The insiders we have tracked throughout this investigation, the whales at the bullion banks, and the strategists in the war room, they do not live in the cave. They live in the real world. They do not care about the price of gold in dollars because they know the dollar is a melting ice cube. They care about control. They care about possession. When they crashed the price yesterday, they were not trying to save the dollar. They were trying to break your spirit. They know that a new monetary epoch is coming, a cycle where tangible assets will be the only shield against sovereign default. They want to enter that new world holding all the gold, and they want you to enter it holding nothing but paper promises. The crash was a mechanism to shake the tree. They needed to terrorize the weak hands. They needed the tourists and the speculators to drop their physical assets in a panic so that the establishment could scoop them up at a discount. It is a transfer of sovereignty. Every time you sell a physical ounce because the paper price went down, you are handing your financial freedom to the very people who are debasing the currency you are trading for. You are trading a king for a servant. You are trading the eternal for the ephemeral. The ultimate trick of the system is to make you value the currency more than the asset. They have trained you to measure your wealth in dollars. But the dollar is not a unit of measurement. It is a unit of debt. It is a claim on the future labor of a bankrupt nation. Gold is the opposite of debt. It is the only financial asset that is not someone else's liability. It has no counterparty risk. It does not need a government to exist. It does not need a central bank to validate it. It simply is. So when you look at that chart and you see the red line plunging down, do not see it as a loss of value. See it as a glitch in the matrix. See it as a temporary distortion in the projection caused by a change in the management of the theater. The play is not over. The actors are just changing costumes. The reality is that the debt is still there. The deficit is still growing. The geopolitical fractures are widening. Nothing that matters has been fixed. They have simply lowered the price of the lifeboats, while the ship is still taking on water. We are standing at the edge of a great realization. Most people will never turn their heads. They will stay chained to the wall, mesmerized by the dancing shadows, until the fire goes out and leaves them in total darkness. But you are still here. You have watched the forensic evidence. You have seen the footprints of the whales. You know that the game is rigged, and that knowledge is a heavy burden. It alienates you from the crowd. It makes you a stranger in a world that loves comfortable lies. But it also makes you free. They want you to feel isolated. They want you to think you are crazy for holding on when the screen tells you to sell. They want you to surrender your position and go back to sleep. But we are building something here that is stronger than their algorithms. We are building a network of eyes that can see in the dark. If you refuse to be a prisoner of the cave, if you choose to value the truth over the illusion, then you need to share this investigation. Do not just watch it and nod. Send it to the people who are panicking. Send it to the people who are blind. We cannot fight their capital, but we can break their narrative. The only way to win this game is to stop playing by their rules and start playing by the laws of physics. Kevin Warsh can control the price of today, but he cannot print more gold. Remember that.